And welcome to everyone that's joining us for our session today, getting into all of things you need to know about finance. I'm so grateful to have David here. This session is designed for those of you who've been joining us on a few of our other webinars. This session is designed to be a little bit more interactive. We know that some of the questions might be really specific to what you need to know, and we want to make sure that you sort of leave here getting as much information as you need for your personal circumstances in your organisation. So as I mentioned earlier, there's the chat function here, which you are welcome to play something into the chat, and you can just direct that to us if you wanted to, or you can choose that to be public. David will start with an overview around what's happening with all the announcements and create a really nice foundation. And then we can just sort of go from there and see where it takes us. Firstly, before we begin, for those of you who've been joining me on these webinars, we often start with a way to bring us all together, which is just through a collective breath. It's very much optional, but I've been taking it just so I feel connected to you all and feel regulated before we get into content. Taking a pause during these challenging times is really helpful, as I think it allows us to access that learning and creative part of our brains. And I know for me with finance, I need a lot of space to retain all of the information. So I'm going to take a breath in now if you wanted to join me. And a breath out. I'm also going to acknowledge the land I'm joining you from today, which is Wathaurong country in Victoria, and pay my respects to elders past and present, and my deep gratitude for these times, for having the trees, the seas and the breeze as my allies in such challenging times that we find ourselves in. So David, thank you for being here. David is the owner of CINCH Finance and Operations, and he's been working in the NDIS for the last 6 years, providing organisations with savings, efficiency and confidence in decision making. CINCH does this in 3 ways: savings through outsourcing, so virtual CFO, finance roles, leadership and change management, financial modelling and analysis, turning organisations around and preparing them for growth opportunities, and culture awareness and change through leadership programs. So David and his team love working in this sector, and they look forward to helping organisations into the future. So thank you. I might just hand over to you, because I know absolutely nothing about finance. So this is the first webinar where I feel like I can't even tag team with you in conversation. So I'm very much open to here to learning. So thank you.
Okay. Well, thank you and welcome everybody. I've got some slides which I'll read through. A lot of it is interpretation of what information has come out there. And what I find is during these times, we get a lot of information, a lot of emails. So the purpose of, or what I've focused on at the moment, is the JobKeeper scheme and what's come out recently. And I've also, at the end of explaining through that, I'll touch on some of the other stimulus packages and things that people may not be aware of, which will help in times like this. So if everyone wants to take in another breath, here we go. So thanks for the introduction. Just wanted to talk, we're going to make these slides available as well, aren't we, Anna, for everybody?
Yeah, we'll be making them available, but I can share now if you want to talk to them.
Will they be able to see me as well?
Yeah.
If you like. So I'll just go through the slides, but I just wanted to mention on each of the slides, there is a reference to the particular source, such as the ATO website. So don't take this as specific advice that I'm providing you. Suggest that, as a disclaimer, suggest you get some, if you're not sure, contact me and I can give you some specific advice, because everyone's situation might be a little bit different. So what we're trying to do is, I'd like you to leave away from here understanding what is available and what you need to look at to be eligible for these sort of things. So the first thing I've got here is the JobKeeper allowance. That's probably one of the main areas. And these slides are focused just on the not-for-profit sector. I'm not talking too much about the commercial aspects of things. So the first thing we need to look at is eligible employers. So we're looking at this to determine whether you're entitled for the JobKeeper allowance. So the first thing is, are you an eligible employer? Do we have eligible employees and that are currently employed and that were employed from the 1st of March? Is your organisation facing a 15% downturn in turnover, including donations? And that's basically looking at, when you prepare your BAS, what do you include as revenue when you're preparing your BAS? This is what you're basing your turnover on, the 15% downturn in what you'd normally include as revenue in your BAS for GST purposes. Turnover is compared to prior years. So in the literature that's been, or the ATO website, we're comparing March this year with March last year. And I'll talk about if you weren't in business 12 months ago a little bit later. They've added in here a projected figure. So first is your turnover March this year 15% less than March last year? A lot of our clients potentially have grown in the last 12 months. So we're looking at whether, what's the impact of COVID-19, given that there's been, it's not a comparable month to month. So one of the other areas that we're looking at, the ATO is looking at, is projected. So can you project April revenue compared with April actual revenue last year, or even look at the projected quarterly April 2020 with the prior year quarterly figures. In any of those situations, if the revenue is down 15% or it's projected to be down 15%, then it goes towards being an eligible employer. Now, if you don't qualify at the moment, you can continue doing this test until you determine that you do qualify. So if your revenue, maybe there's a certain project and you're not sure if your revenue is going to decrease by 15%, if that does happen, continue to test. And if that does happen, say in June, you might work out that the revenue has dropped 15%, then you can meet the test, apply, and then from that point on, you'll receive future JobKeeper payments if you are eligible. There might be a number of people in here that are self-employed or someone looking at this. So talking about sole traders, the JobKeeper allowance applies to sole traders who do not have a wage from another business. They must meet the decline in turnover test of the 30% decline in turnover, because they're not a not-for-profit or not a charity. They must have an ABN registered before the 12th of March, and they must have assessable income from this business in their tax return 18-19 year, potentially if it already lodged. They must be actively engaged in the business, not entitled to another JobKeeper payment from another potential employer, an Australian resident for tax on the 1st of March, and an Australian citizen. So there's probably potentially... Sorry,
I was just going to say, David, just wanted to ask you a question from the crowd, if that's okay, just on this JobKeeper. Can you compare to a different period rather than the previous year? For example, 6 months, if that is more applicable.
Well, I'm just going to say, yeah, what the ATO is looking for is what has been the impact on your organisation from COVID-19. So in the slide that I've got at the moment, the commissioner, if I was going to say that if there's circumstances where you don't think that the month on month is comparable, the commissioner, you can apply to the tax commissioner with some additional information to justify how you've been impacted. So if that is 6 months, because you had a project that, you know, potentially 12 months ago has now ceased, then a more comparable figure might be 6 months ago. The tax commissioner will need a little bit more information to determine whether you're eligible, and what they would like to see is how you've adversely been affected by COVID-19. So in short, if a 12-month period, month to month, is not comparable for a number of different reasons, a 6 month or another month might be comparable, but you just might need to add some additional information when applying to the tax commissioner.
I think it's quite a challenge for our sector because over the Christmas period in particular and around, like, that's actually the lowest, sort of the quietest time for the sector because of school holidays and all the other things. Whereas sort of going into the period at the end of the year, that September to November is definitely a peak period, which is more reflective of service.
Yeah, I mean, if you can have a look at a 6 month period and then 6 month period, you know, this next 6 months. But I'd like to also comment that the commissioner is also looking at your forecast. So if you're expecting that you might not be declining at the moment, given that I think Easter was in April 12 months ago as well, and you may not have significantly been affected at this point, but May and June, you can project that the decline will occur, then the commissioner is allowing you to apply. If you're a sole trader, just go back to the sole trader, they need to show that their revenues declined by at least 30%. Now, the commissioner has said in some of the literature that if you apply and in good faith, your estimate is 30% decline, but the actual result over time is not 30%, or, you know, they haven't stipulated what percentage, but if you don't reach the 30%, they'll not going to be too hard. But if you've grown in that time and potentially falsified some information, that's when they'll start to investigate.
Oh, just one more question on self-employed. This is a question. I have only been operating my FDC since January. Will they base it from the months I have been operating, or does it mean I'm not eligible?
I do have some information.
Okay, we'll get to that.
Yeah, I will answer that.
Sure. Yeah, no worries.
I don't remember off the top of my head. Yeah, so there is some rules around that I'll come to. Okay, so if we've determined that we're an eligible employer, we need to look at who our eligible employees are. That's on slide 6. So an eligible employee is someone that is permanent, full-time or part-time and were on your books at the 1st of March. You could have a long-term casual. That the definition of a casual would be regular and systematic working and payments, some sort of regular, for at least 12 months and were employed on the 1st of March. Now, to be eligible for a casual, they need to nominate. For example, they were not a permanent employee of any other organisation. Also, to be an eligible employee, they're not in receipt of government paid parental leave or on workers' compensation where they were totally incapacity to work. Okay, and the employee has to agree to be nominated by you as the employer. and I'll come back to the nomination. There's an actual form that you need to get your employees to complete. So the amount of the JobKeeper payment, it's $1,500 per employee per fortnight, and that's the gross amount. So when you're paying your employees, you need to tax it accordingly through your payroll system. The actual JobKeeper payment is a payment to the employer. It's a wage subsidy. And it's paid to the employer in arrears. So the first payments, it's monthly in arrears. The first payment will be in May 2020 based on your payroll or the eligible employees from the 30th of March up until the fortnightly pay periods, which will be, I think, the 26th of April. There was 2 pay periods in that time. So this, on slide 7, there is a table that shows employers, if they were claiming for the whole 6-month period, the JobKeeper amount, from the 30th of March to the 27th of September, that's the period that it's been nominated, the employer will get a rebate of $19,500 per employee. And in that table, it talks about the fortnights, the periods that they'll be paying or reimbursing the employer. So at the moment, one of the questions might be, what if casuals were earning less than $1,500 per fortnight prior to the COVID-19, prior to the JobKeeper? But based on the information that we've got available, and given that you are an eligible employer and they have met the criteria for an eligible employee, and they've nominated you as the nominating employer, then the minimum amount that they would now receive is $1,500 per fortnight before tax. Okay, so how do we enroll and apply for it as an employer? There's a link that I've provided there with a number of steps. And I'm just going to summarize them here. But you need to work out your eligibility as an employer and employee. The employee needs to nominate, and if organisations haven't already, there was an expression of interest. So if you haven't applied for that expression of interest, what happens next week? So applications will open from the 20th of April. And to apply for the JobKeeper, you need to log into your ATO business portal, and there will be an application process through there. So logging into your ATO business portal, as if similar to preparing your BAS, you'll still need the MyGov ID to log in, and then you'll need to make sure that you are I'm not sure what I'm not sure what it looks like on the ATO portal, but there'll be directions there to nominate your organisation to participate in the scheme. It will also ask you for your bank account and the employees that you're nominating, I think. Now, if you're clear that you're an eligible employee, an eligible employer at the moment, you're meeting the tests, and the revenue has dropped for March and April, you'll need to register. This is what the ATO is advising, that you need to register before the 26th of April to be entitled to get the claim, to make the claim from the 30th of March to the 26th of April period. And you also need, and I think I'll talk about this in the next bit, you need to be paying your employees, those entitled, because this is a reimbursement to the employer. So they're reimbursing you after you've paid the employees, in the following month. So the employees need to be paid. The way the government or the ATO monitors this is through the single touch payroll system. So there might be a process, some information may come out from your payroll software advisors on whether anything needs to be flagged on who's an eligible employee. But the key that I'm understanding here is that we need, if you wanted to claim the first month, we need to log into the ATO portal, business portal, and apply before the 26th of April. So really, it opens next Monday, so we need to apply next week.
David, can I just ask a question?
Yeah.
We have a casual employee who moved from permanent to casual. They changed roles in May last year. Would she be eligible?
Well, their continuous, my response would be that they were employed prior to that. So they're continually been serving the organised, continually employing. The date of service was before that period. So yes, I would expect that they would still be, if they're eligible, like if it's their, if they're not claiming it from someone else and they meet all the employee eligibility tests, because they were employed by the organisation prior to becoming the casual, then yeah. Yep. So just on the payment to employees. Okay, so the JobKeeper is a wage subsidy for employers. So it's to keep people employed. And the JobKeeper scheme covers many other industries that have been adversely affected by COVID-19. It's a wage subsidy. We just have to remember that. The reason why is because if you're still getting your workers, if they're still working and they're earning more than $1,500 a fortnight, you don't pay it on top of what they're already earning. It's a wage subsidy, so it'll subsidise the employer for the cost of keeping employees in work during this time, which is for the next 6 months. So the minimum paid to an employee that's eligible is $1,500 a fortnight, and it has to be taxed through your payroll system. Now, like I said, if they're engaged in the business and they're earning more than $1,500 and they're still eligible because your revenue has decreased and you've met those tests, the rebate is paid to the employer. They're meeting the minimum requirements of paying an employee a minimum of $1,500. So there may be some questions around if an employee was earning less than $1,500 a fortnight, they will now receive a minimum of $1,500 if they were ineligible for the payment.
Another question is, should we hold off on topping up to $1,500 until accepted into the scheme and processes back pay?
Well, the literature is saying that the eligible employees need to be paid so I'm thinking that they'll find out through the single touch payroll system what they were previously paid. It's hard to answer. I mean, I don't know people's cash flow, but based on the ATO guidelines, they will be eligible if they've been paid. So in actually what they're saying is you need to be paying the minimum of $1,500 to get reimbursed and to meet the criteria of the JobKeeper allowance and be reimbursed $1,500. What the ATO is saying is that they're not going to fund the payments. They're reimbursing an organisation for making the payments. So I would suggest that the employees that are eligible, if you know that you meet the tests, then what the ATO is saying is that you will be accepted the employees need to be paid. So there's a cash flow timing issue of a month. If I'm not sure what the ATO, I can't answer that question on what the ATO would do if the employees were paid after that you've accepted. If it's a one-off and they're eligible and you've got no other cash flow, you know, it's a one-off. I'm not sure what the ATO would do.
Just another question is, do we have to have this as a separate line item when paying employees if we pay over the 1,500?
If you're paying over the 1,500. So what I'm seeing is if they're doing ordinary hours of work, the employer, and they're earning more than $1,500, the employer will keep the rebate. And on your pay slip as an employee, you'll get your ordinary hours of work. If it's being topped up by the rebate, the JobKeeper, I would have a separate line in my pay line items, in my pay slip, to show what someone has received, because then you can match it up if you need to. Yeah, I would put it in as a separate pay item.
Thank you.
It's still taxed the same as your ordinary earnings. It's still taxed. But if someone's earning over $1,500 a fortnight, then you wouldn't receive that rebate. The employer will keep that if you're an eligible employee. It's only going to be there. It's mainly there for people who are not earning $1,500 a fortnight, potentially not working, and you're keeping them employed with a minimum payment and getting reimbursed from the ATO for the exact amount, that $1,500. If you're topping it up, they're doing some hours and then you're topping it up because they're not meeting the minimum, then have a separate pay line, a pay item, to show that they've received some of the rebate. Eligible employees. Okay, so the rebate applies from the 30th of March, which is when the scheme was announced. And like I said before, payments will start once you've been approved through the ATO business website. You will then start, the employer will start to receive reimbursements in from May, according to that schedule. One of the questions might be, is superannuation guarantee paid on the amount? It's not required to be paid. However, if an employee, it's optional for the employer to determine whether they want to pay it or not, but it's not required. If an employee is working some of their ordinary hours, then super guarantee would apply to those earnings. So I would just make sure that you're checking super guarantee. One of the questions that I've been asked from my own staff, I haven't got an answer on yet, is around whether leave accruals continue. So this is an example, if someone, let's say a full-time person, it's easier to work out 38 hours a week. If they're on standby because there's no work for them, not so much standby, sorry, they're on the JobKeeper and there's no ordinary hours for them to do, they're receiving a minimum of $1,500 a fortnight. I haven't seen anything at the moment to determine whether they get their full annual leave accrual or long service leave accrual or sick leave accrual. If we compare that to stand down arrangements, then they would be entitled to receiving that accrual. So I need to investigate. If we base it on what the stand down would be, then you should be accruing the entitlements. But I'm not. It's the grey area at the moment. I haven't seen anything which specifically deals with those cases. So for an employer, potentially, we may need to look at continuing their normal hour accrual for annual leave, long service leave, sick leave, if they're on the JobKeeper minimum and not doing any ordinary hours. If I find out any more information, I'll pass it on. So looking at, from an employer point of view, looking at some compliance or governance areas. So the ATO is monitoring organisations through lodgement of BASs. So that will tell the ATO whether there's changes in your revenue. Obviously, if there's not a clear change, we might need to provide some additional information to the tax commissioner on that application. They'll also be looking at the single touch payroll to determine that you are paying the minimum amount for employees. So the responsibility is with the employer to make sure that you're paying the employees correctly at the minimum and that they have been paid. So that the literature, that ATO has specifically said that receiving the wage subsidy, the employer must have already paid the employee. And then the employer is reimbursed monthly in arrears. They've also said potentially there's serious consequences and penalties for any illegal actions under the scheme for false or misleading information by either the employer or the employee.
Sorry, David, can I just ask a question?
Yeah.
Does the SGC apply to the top-up portion?
No, in that situation, what they're saying is I would apply it to the ordinary hours, and the top-up portion, if it's specifically JobKeeper, then the ATO is saying you don't need to pay super guarantee on that, but it is up to the employer if, it's 9.5% of whatever that portion is. So it's not a huge amount, but if the employer can pay that if they wanted to. It's not mandatory. Is what is in the literature. So just to recap on the JobKeeper, a summary: register your interest if you haven't already. Communicate with employees and determine who's eligible, and complete the JobKeeper. There's a JobKeeper employee nomination notice, which is a special form which I've included in one of those links, and an employee must fill that out. And you keep it on file. At the moment, it doesn't seem like you need to lodge it with the ATO, you just keep it on file. You need to continue, as an employer, continue paying the employees the minimum each fortnight. Notify the employees that you will be claiming the JobKeeper payment and issue the employee a notice to say that that's what you'll be doing. That's just the responsibility of the employer. And then from the 20th of April, you'll have access to the ATO online portal to enrol in the scheme. There'll be an enrolment form, follow the prompts, use your MyGov ID to access it. And if you wanted to be eligible for the 30th of March onward, you need to lodge the application before the 26th of April. Now, I'm not sure what happens if you're trying to lodge after that date and trying to receive payments before the 26th of April. But reading between the lines, they're not looking at retrospective or backdating applications and payments. Now, the ATO online form is going to ask for your bank account details. So that's your business bank account details, because they'll be looking to pay that into your employer's bank account, into the business bank account. And the other thing is just to check with any payroll software providers that you might be using to see if they're putting any changes into the payroll system for the single touch payroll lodgements. And the ATO may have put some guidance around some changes or flags that you might need to ensure has been ticked, which meet single touch payroll for JobKeeper subsidy. I haven't heard of anything at the moment from any of our payroll suppliers, but they should come out soon. So I just wanted to. It's all right.
Oh, I cut you off. I was just going to go back to that question a while ago and see if that's been covered later, or if it's in the JobKeeper section around newly operating. And
newly operating. Let me just have a look. So newly operating, from what I've seen, as long as you were in business before the 12th of March, so we're talking maybe 6 months ago, aren't we? Was a question.
It was, I've been operating since January. Will they base it from the months I've been operating, or does it mean I'm not eligible?
Yeah, so from what I've seen, you'll need to probably provide some additional information to the tax commissioner on lodgement, and it's just basically to show that how it's adversely affected you. So what the rules are basically saying, if someone's set up, last month as a self-employed business, they would fall outside of the JobKeeper allowance, and they would have to then go and seek potentially the job seeker benefits. In this case, if you're in operation in January and you don't have a comparable month, but you can show that your revenue is significantly affected, then still apply, and you may need to provide some additional information because you don't have the tax return from last year and you don't have a comparable month. So yeah, definitely still apply, showing that your decline in turnover is more than 30% if you're a sole trader. But you might need to provide some additional information. Now, I don't know what that additional information might look like. Potentially, it might be that you were working, 40 hours a week as a sole trader from January. It may be that you've got the business plan and you were looking to grow, and they might be enough to show the tax commissioner that you're entitled to the JobKeeper. If you've got employees as well, if you're employing people or even contractors, then that's some of the additional information that the tax commissioner would consider that you've been adversely affected. So I just wanted to talk a little bit more. I mean, that's all the information I have on the JobKeeper package. A couple of the other stimulus packages that were announced and sort of talked about may not affect everyone, but we've got a cash boost, which was up to $100,000 withholding refund through your BASs for the March to the September quarters. I'll talk about that one in a second. We've also got the Ndia advance payment. Now, I've said that is a loan, so treat it as a loan, put it on your balance sheet. It's just a cash advance and it will need to be repaid. The Ndia 10% price increase. So these are some of the other things that will help. The unsecured working capital loan. So the government announced that you can go for up to $250,000 loan with one of the major banks, unsecured. Now, just to give you an example and tread with caution, the up to $250,000 is just for working capital, and it needs to be repaid over 3 years. So the first 6 months, they're saying that you don't need to repay or make any repayments, but the interest on the loan is going to be added to the loan, which makes the repayments a little bit more over when you start having to repay. But as an example, if you did borrow $250,000, you'd be looking at repaying $9,500 a month once, after this 6 month period for the next 3 years. So I would definitely do your research on whether you need that sort of loan, because it does need to be repaid, and that's at about 4 or 5% interest. The JobKeeper program, which we just spoke about, and there's other for smaller organisations or smaller businesses, there are various state grants, for $10,000 here and there that are starting to be announced, that some small businesses that may not fall into some of these JobKeeper programs or the cash boost system, they're offering around. So just keep a lookout for that. So just a bit more detail on the cash boost stimulus package. It was brought out before the JobKeeper, and it's a temporary cash flow support of $20,000 to $100,000 in cash flow after lodgement of your activity statements. So the way that they're monitoring this is through your MyGov ATO business portal, based on the pay-as-you-go withholding tax that you're deducted from your employees, paying it to the tax office. The ATO are giving you a credit towards that of $20,000 up to $100,000. Now, the timing of that and how they're working that out is, if your pay-as-you-go withholding, so the tax portion in your March quarterly BAS, determines what sort of credit or refund that you'll be entitled to as a business. If you're small, the minimum is $10,000. So you'll receive between now and June $10,000, and you'll receive the equivalent after September, towards the end of September, of another $10,000. If you're a larger organisation and your pay-as-you-go withholding is higher, and the maximum you will receive between March and June is $50,000, and you'll get the equivalent in July, August, September, and October next year. So what it is a credit on your ATO business account, and it's to offset, it's a cash boost, and it's to offset some of the wages in addition to this JobKeeper allowance. Hang on. Sorry.
I love it. We're all just living these strange worlds in our homes, having to navigate everything.
Yeah.
Maybe they're interested in the cash boost too, David.
Yeah, I think so. Okay. The last thing there. So some of the things to consider is the timing of the cash boost and the timing. So cash flow at the moment. These schemes are basically to reimburse after you've spent the money. So you need to look at your cash flow, working capital. And if you're looking at the loan, factor in the repayments of up to $9,500 to pay off a $250,000 loan over 3 months, 3 years, sorry. And I'm not sure, haven't heard when the NDIA want to receive the advance payment. There's no timing on that at the moment. So that is basically, I've covered off what we're aware of with the JobKeeper. And the key learnings around the JobKeeper is just to check your eligibility, employee eligibility, and start to apply next week. If you're close to, look, my opinion is if you're close to 15% reduction in turnover, or you're projecting a 15% reduction in turnover, and it's very likely, then apply. Or if you're thinking that it's not going to impact you until a later date, apply then. You only need to apply once you've approved. You don't need to reapply, and then the scheme will be in place.
Just got a couple of questions for you, David.
Yeah.
One of them is, are you going to talk more about the 10% price increase in a minute?
I
can let, oh, do you want me to just ask you a question?
Yeah, sure.
Yeah. Do you have much info on how many providers in your network have implemented the price increase? We are holding off to gather more info about how this will be received by our clients. It seems a lot of providers on Facebook groups are not passing on the increase.
Yeah, look, most of our providers are looking at the 10% price increase to implement that. Some of our providers who are not in the ECI space have already implemented it. The issue around that question is what happens if, in this space, what happens if the participant's plan is 100% utilised? They have, because the 10% price increase is coming out of the existing package. So the issue will be if we've utilised the package and they've still got a month or two to go until they get a renewal, we can't claim anymore. Are you going to stop service? The NDIA are basing the 10% price increase across the sectors based on plans not being 100% complete. I think the statistics were around, on average, 70% plan completion. So in our network, we're seeing the 10% price increase being applied for this 6-month period. The issue, like I said, is we need to be aware as providers and employers, we need to be aware of the utilisation of that plan. And if it's close to 100%, we need to make a decision. Do we go back to the planner or the NDIA and say, look, we've implemented the 10% price increase. We're running out of money because you haven't topped that plan up. Can you either give us some more money, or do you decide as a organisation to continue service but not claiming until you get the plan renewal? And from what I understand, I'm pretty sure I read something that plans are automatically going to be renewed. I'm not 100% sure on that and how that works, whether they get the same amount or what at this point. But I'm assuming that if there is an issue, it will be if your clients are reaching 100% plan completion. If they're not reaching 100% plan completion, then it's not costing the client any more money. It's just utilising more of their plan.
Thank you. Another question is, because the ATO is using GST activity statements to determine if an organisation meets the 15% turnover reduction rule, many not-for-profits won't reflect the turnover reduction in this manner. Will we need to supply further information to the Tax Commissioner?
Many not-for-profits won't
reflect the turnover reduction in this manner through using the GST activity statements.
I'm assuming that because they're not lodging business, they're not registered, I guess, for GST potentially, or maybe lodging a nil return. In that case, yes, the Tax Commissioner would look for potentially additional information, and all that I'm reading that all that is looking for information that can show that the impact of COVID-19 on your organisation has had an adverse impact on your organisation. So let's say if you're earning $70,000, if it's a sole trader, you don't need to be registered for GST, or you don't have 12 months worth of information, or haven't lodged a tax return for last 12 months. I think additional information to prove your case or show your case, and the Tax Commission is going to get a lot of applications. So I would make it as easy as possible for them to decide, how it's going to impact your organisation. So obviously, if you don't have any GST or BAS returns, once you get the application approved, it's approved. You don't need to justify anything from that point on.
So that maybe answers the next question of, do you have to keep proving your eligibility for JobKeeper throughout the 6-month period? So no.
No, not at the moment. But I'd say if your organisation suddenly, if for some reason it grows and your revenue is a lot better than what you thought it was going to be, I would potentially contact the tax office and say we don't need the JobKeeper at the moment. It's highly unlikely, but in answer to that question, no, you don't need to keep proving your eligibility.
Yeah.
If you don't apply by, let's say you don't apply until June, then the eligibility starts from that date you apply onward. From what I'm seeing, it's not backdated. If you apply in June, you don't get to claim from the 30th of March. You need to work out when you'll be entitled. In most cases, it could be that you're entitled at the moment because you can clearly see a change or a decrease in your revenue.
And just the next question, the final question that's sort of waiting to be answered, the cash flow boost, is that required to be repaid?
No, not required. Cash flow boost was the first, I think it was the second announcement the government came before they realised they needed to do something bigger. And it's basically a credit on your ATO portal so that you'll see it when you lodge your BAS. You won't have to pay as much because the ATO will apply a credit, and you're basically they're not going to pay it to you, but it just means that your pay-as-you-go withholding tax, you don't have to pay as much because the ATO has contributed towards some of that. I was going to mentioning something about one of the questions that we just had. Is there any more questions? Oh, I remember. With any of the larger organisations, if they're not quite sure, so a lot of the clients that we've worked with have grown significantly in the last 12 months. So comparing the revenue this month with the revenue 12 months ago, we may determine that it's not quite comparable. So we may need to show some additional information on how COVID-19 has adversely affected us, even though we might have only changed in our revenue by 10% or something. There's other factors. We may have taken on 50% more clients, and the effect is going to, we may have increased our payroll by another 50%. So there's some additional information that some of the bigger organisations may need to consider if there's not a immediate drop in revenue in March or April, that we need to consider and potentially supply some additional information.
Okay. There doesn't seem to be any more questions at the moment. So for anyone there who's got some, please pop them in the chat. Did you want me to go back to the slides, David, or?
Look, I think I've finished through the slides. All I have left on the slides is there's a couple of references. There is I've put in there, if anyone's interested, the official documentation from Treasury, just in case you've got some extra, if you're looking for any extra reading material. And there's a few links to some of the chartered accounting JobKeeper payment summaries and things like that. I'm sure you'll get a lot throughout the day from other organisations. There's a slide there just with my contact details, phone number, website, and emails. So if anyone does have any specific questions or wants some specific advice, we're more than happy to help out, or obviously contact ECIA.
Perfect. So just to, I guess, start to wrap up with attendees, if there's any more questions